Welcome to a financial planning podcast with a down-to-earth vibe. Sasquatch listens while foraging berries. This is Through the Pines. On this episode, we explore what to do with your money when it comes to risk management and risk management techniques. And so what is financial risk management? What are some of those techniques like avoidance, retention, transferring, loss prevention, and investment approaches? So using bonds, derivatives, diversification, asset allocation, position sizing, that type of thing. Also the psychology of risk management like loss aversion and what is the cost of risk. So welcoming in our guests for this episode are Rex Baxter and Brandyn Smith with planwithbaxter.com, 2023 and 2024's Forbes Best in State Wealth Management Teams for Utah and Advisor Hub's fastest growing advisors to watch under $1 billion, as well as the receivers of the Ameriprise Client Experience Award. So not only do they know what they're talking about, but they do a good job at it. So thank you, Rex and Brandyn, for being here today. I think this might be one of the earlier questions, I'm assuming, when you chat with clients about their money is risk. And what is this how do I not lose my money? Right, Brandyn?
Yeah, thanks for having us on.
Yeah.
And this topic specifically is just a great topic, widely misunderstood, I would say, by most people.
Okay.
And so this is something that I like to go through with clients right off the gate, even if it's just like a 401k enrollment meeting. I'll ask someone, so it's important to understand what risk is.
Okay. Should we start there with sort of a definition of what is, do you have a definition for it?
Yeah, I kind of do. Yeah. And obviously there's a lot of different types of risk, but risk within the stock market. I like to ask my clients, so what is risk? Is risk that one day I'm going to call you and say, bad news, the stock market crashed and it's all gone? Right? And I ask, is that possible? And of course, anything is possible. But what does that world look like? That looks like all of the businesses in the world closing their doors saying, you know what? We can't make money. Amazon saying, hey, we're not delivering packages anymore. Walmart closes those sliding doors and locks them forever. Apple doesn't make iPhones, right? It's a world where businesses...
The horror.
But it's a world where businesses cannot make money because that is what drives the value of a stock, is the ongoing generation of cash or of any currency, really, because, I mean, stocks make money in various currencies. And so if companies cannot make money anymore, that means all the companies are closed. And is that possible? Sure, that's possible. Is it likely? I hope not, right? And if it is likely, does it really matter whether we put cash under a mattress or in the bank, or it doesn't matter probably at that point, right? And so the question comes back, what is risk? And risk then tends to become, assuming we have a well-built, properly diversified portfolio, is, hey, the stock market moves and it's going to fluctuate. Sometimes it's going to drop. Sometimes it's going to run, but we know with history as a guide that there may be a long period of time, 3-5 years, where the market's going to dip, and it's going to take that 3 to 5 years to come back. And if that's the case, then we can't access your money with taking massive losses. And I would define that as the most basic definition of risk in the stock market. And once people can really wrap their mind around, okay, that's what risk is, then we can start to take on risk because there's return to be gained from taking certain amounts of risk and utilizing risk within their financial plan to put them ahead.
Okay. Rex, do you want to expand on definition at all? Or is that good? No. Okay, good.
No, I think that's a great definition of risk. I think it does mean something different to everybody. And I think part of that is their upbringing. I think that risk to a lot of people means loss of capital. And to others, it means lack of security, lack of income security. To others, it may mean, it may mean just the swings of up and down that's uncomfortable. It's, there's a lot of different meanings for individuals. And I think framing that, helping clients frame that is important.
Okay. So I pulled some of the questions or the outline for this particular podcast off of an Investopedia.com article, and their they put as a definition to what is risk, as risk management involves identifying, analyzing, and accepting or mitigating uncertainty in investment decisions. Fair? Uncertainty?
Sure.
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 But-
That's a little technical.
But I
Yeah.
think it brings up a good point is mitigating risk, because while we all understand we need to take risk in life in general, right? If you live a life where you literally refuse to take any risk whatsoever, you buy insurance policies on literally everything, right? And you're just like, you're not going to have any cash flow, and you're not likely going to be able to, and finance, that's just for finance. Outside of life, I mean, you have to take risk, right? You have to take risk to find someone to love, right? You need to find risk to, I mean, there's a lot of risk in life.
To find someone to love. It's
Not
very
to
risky.
love. Yeah, no, but life has risk, but that doesn't mean it's bad, and it doesn't mean we shouldn't take it. However, if we can understand it, then we can maximize our decisions.
Well, that sort of leads into this for like avoidance, right? Like avoiding risk altogether. According to this, says the most obvious way to manage your risk is to avoid it completely. But does that incur other risks by avoiding it?
It absolutely does.
Yeah.
Right. And so I think regarding the definition of mitigating uncertainty, I don't think that's a definition of risk. I think mitigating uncertainty is a way to reduce risk, is a definition of we're going to try and reduce risk. Uncertainty is the risk. And so mitigating it doesn't define it. It just kind of describes, what you're doing to it is all. I think in regards to avoidance, there's absolutely other issues that arise, because if you're avoiding taking on risk, then you have an opportunity cost of what could those, and I'm going to frame this in the terms of financial matters. I'm going to frame this conversation, this podcast, in a sense of investments and financial growth, because that's what we're all about through the Pines. So I think opportunity cost, when you avoid risk, then what could your money have been doing for you? Could it have been growing in a CD? Could it have been buying a business? Could it have been buying real estate? What's the opportunity cost on that? I think you have inflationary risk. If you're avoiding risk, then does the cost of goods and services increase faster than where your money sits? And in the last couple of years, this is important because we've had a bout of inflation, unlike we've seen for a couple of decades now. And so when you all of a sudden you have inflation of 5, 8, 10%, and your money is sitting in a savings account earning 1%, then you're losing ground. And so even though you're avoiding stock market risk, you're accepting inflationary risk. And that's an issue. And so people sit there and they frame it of, oh, I'm very conservative, I'm not going to take any risk. Well, you absolutely are taking risk. You just are being blind towards the types of risks that you're taking.
It's a beautiful day when you recognize that there are risks in every decision you make. Not to go too far away from finance, but I have a trampoline, right? And is there some risk? There is some financial risk to that, but is there some risk of getting injured for my kids? Of course there is. But then there's also risk if I don't have anything fun outside for them. There's the risk that they're sitting inside watching TV all day, and that contains certain risks. And like that, finance too has, just like Rex said, there are risks in finance with inflation. There are risks of currency risks, right? I mean, there's all sorts of different things outside of stock market fluctuations that we need to be aware of. I was meeting with, and this was forever ago, but I was meeting with a client who had this, it was like an indexed annuity, and it was just performing just pitifully, right? I mean, 1% to 2%, and they're like, but it's safe, it's not going to go down. And we did a plan for them, and I showed them like, hey, this is how this ends up long term. You safely and securely run out of money way too soon, right? Because we just don't get the growth you need. And so we would either need to, really, save a lot more, but sometimes lack of fluctuation, even though that feels good in the short term, can be the most risky decision. if we're not going to hit our long-term goals.
Yeah. So this kind of goes into, they framed this word in the article as retention, but it's acceptance. In other words, accepting that risk comes with the territory as far as your financial life, like you say, Brandon, and then in the financial world as well. It's what do you do with that risk, and how do you define it, and then I guess like how do you face it, right? And then make moves upon your decisions there.
And another example of risk acceptance is like taking less insurance, right? I have a high deductible health insurance plan. I assume some extra risk. I take that risk on myself, hoping to get rewarded for that, right? By paying lower premiums. And I have been, right? Year over year, I've paid a lot less into health insurance than someone who chose a lower deductible plan. Now, did I get lucky? Maybe, a little bit health-wise, but that is a classic example of accepting risk. And there's some risk that we can absolutely accept, and there's other risks that I'm not willing to accept, right? If I were to pass away, I'm not willing to risk that my wife has to sell our house and move out into the street, right? That's not, and it's everyone's, choice individually. But for me, that wasn't one that I wanted to accept. On my house, right? I want to make sure that I have proper coverages on my house, on my autos, right? Like I want to make sure that if I crash into somebody and injure them, that there is insurance there to A, take care of what I damaged, but B, make sure that someone doesn't come after me and sue me for what I've tried to build in the net worth side. And so there's some risk that, let's take, what, if I have to pay a max out of pocket of 8-10 grand in a year, that's not awesome, but I can assume that and I can recover from it. Whereas other risk, I can't recover from.
Got it. Rex?
So those other risks are transferring risks, right? Is you're transferring that risk to an insurance company, or you're transferring that risk to a third party. And we see that a lot, especially with, whether it's life insurance to where people aren't ready or at the stage to where they can self-insure and retain the risk, whether it's long-term care insurance, again, where they may want to be self-insured and they've saved up and they have enough assets to meet the most likely scenarios of that risk. And so that's transferring versus accepting. And I think a lot of people intuitively know that and understand it, but have a hard time defining that and putting that into words.
Rex, that's a really good point. That's exact, because right now I have to transfer my life insurance risk to an insurance company to take care. But I hope to one day accept that risk and say, all right, I've got enough in savings, I've paid off my house. If something were to happen to me, then we can accept that risk. Yes, I'm still going to lose, as a household, we'd lose the lower of our Social Security benefits. Yes, our tax filing status goes to single, but I can accept that risk because we've got assets to take care of. That's exactly right.
Okay, well, speaking about assets, what type of assets do people use to, or what do you do with your assets to sort of mitigate risk? You want to talk about bonds are a big one, Brandon. How should you use stocks versus bonds? There's derivatives, options, then just diversification. Like, do you want to talk about how an investment portfolio should be structured, Rex?
I think there's a lot of different kinds of risk, right? There's systemic risk in the financial world, and that is risk that we can diversify away from. And then there's non-systemic risk, and that's risk that we cannot diversify away from. And so when we're talking about, the financial markets, we're talking about an investment portfolio, we can diversify away from a lot of the interest rate risk. And we could do that through fixed income, as far as whether we're going to be short on our bonds, meaning that they mature sooner rather than later. And so when we're trying to diversify and protect ourselves against interest rate risk, interest rates going up or down and impacting our investment portfolio, that's what we're talking about, is we don't want to lock in a low interest rate for the next 30 years. Right? Because then we're missing out on that opportunity cost that when rates go up, we're locked in at 3% and rates went up and our 3% bond is not worth very much anymore. Nobody wants that. And so we can diversify that away by staggering our maturity periods in a bond portfolio, by diversifying across different kinds of bonds or CDs, whether we have CDs or, tax-free bonds in certain situations, corporate bonds, government bonds, agency and real estate bonds, treasury bond. There's a lot of different kinds of bonds that are out there where we can diversify that risk. And then on the market side, we can also diversify away some of the market risk, because we may have large companies, we may have small companies, we may have technology companies or healthcare companies, or different sectors of the economy that to where one is zigging, the other is zagging, and that's what you're trying to do, is you diversify away some of that market risk. And that comes back to one of the things that I say a lot, and you'll hear this a lot on the podcast, is concentration is the number one builder and destroyer of wealth,
right,
and diversification is the number one protector of wealth. And that is why, is because we're diversifying away the majority of that market risk and being able to get a more stabilized long-term rate of return, as opposed to enormous swings that contain enormous amounts of volatility.
Okay, so here's a funny question. Do you have too many, can you have too many baskets and not enough eggs? Can you diversify yourself out too much?
I think that this is going to sound like I'm avoiding the question, but I'm not avoiding the question. And so there's a lot of science that says that at a certain level of diversification, you've met about 99%, or I think the actual number is 99.6% of the amount of diversification you can reach. And so, let's say, for instance, that number is 30 securities, 30 individual stocks, diversifies away roughly 99.6% of the market volatility risk that you can diversify away from. And so if you add the 40th, it doesn't get you to 99.9.
Oh.
Or to
there's a cap,
500.
Okay.
It doesn't get you, and so there's always that little bit in there. And so you can, and we see that all the time, to where people will own, hundreds of stocks, or they'll own 50 different mutual funds that do the exact same thing and hold the exact same stocks, and they feel like that's creating additional diversification for them, and it's not. So I think that is a fallacy.
That's stocks. What about if it's real estate and different types of investments? Can you still have those? That number doesn't work for that, right?
I think it depends on what type of risk you're trying to diversify away from. I think there's localized real estate market risk. And so if I own a property in Park City, Utah, that's, going to have very different localized real estate market risks as opposed to Manhattan, New York.
Right.
Right. And so just because I own, 10 properties in Park City, that's not going to diversify away the localized real estate market risk.
Yeah.
But if I own a property in Park City and one in Manhattan and one in Orlando and one in Houston and different areas, then that starts to diversify away that localized market risk. And I think that the concept is similar, to where once I hit a certain number of properties in different geographic areas, that localized market risk then gets diversified away. Now, it still will be risky for that one individual property, but as a portfolio, it will start to diversify away that risk as a portfolio.
And we have, oddly enough, an entire podcast on asset allocation, diversification. Brandon, do you want to just touch on the basics of it, though, real quick?
Yeah. So a wise man once said, concentration is the number one creator and destroyer.
Who would that be?
Of wealth. No, Rex says that all the time. Concentration is the number one creator and destroyer of wealth, and it's true. We've both seen countless instances of people who just owned one stock. It was their favorite stock. They worked at the company, whatever it was, and the portfolio just happened to hit it big and grow, right? At the same time, we've also seen those people that have just one stock and it's a ton of money, and all of a sudden overnight, it goes to nothing. And so, the diversification, Rex mentioned the number 30, right? 30 different stocks reaches the majority of that, and that you hear that all the time, the number 30. The math behind that is, if you've got 30 stocks and an equal weighting to each of those stocks has a weighting of 3.33%, repeating, right? But about 3.3%. If one or two of those, if let's say one of those stocks goes completely bankrupt, your portfolio is still only down 3.3%. And that's why that math works.
Right. And it's, I'm assuming, across all different sectors. And
right.
Yeah.
But the problem is, if one stock hits it big, you've only grown
gained.
doubles,
Gotcha.
right? You only grew by 3.33. And so that's the difficulty. What I found, and this is me personally, I love diversification. For my plan, I've got my entire portfolio is very well diversified. And the reason for that is because I know I've got a very consistent, predictable, long-term rate of return that I can count on, and that gets me to my retirement goals. And so I feel so comfortable in, hey, I don't need to swing for the fences. I don't need to hit it big. I just need to just hit singles and doubles all day long, and I'm going to get there. And I'm confident I can consistently do that.
Brandyn, do you personally take any money and throw it into the this is the big home run money?
No, I don't.
None?
Not a penny of it.
Not a penny.
And I know that can be weird for financial advisors. I know some people like to. And is the temptation there? Actually, not a ton. My wife always wants me to. Brandyn, buy me a stock. I was like, we got tons of stocks. Don't, she's like, no, I want one stock that I can say I own. Okay, I'll pick one out and show you. But like I don't know. For me, I like the diversification. I like the steadiness of it. I like the predictability of it. And but that probably goes back. I don't gamble, right? We're going down to Las Vegas this weekend to see some friends, and I'm not going to even gamble $1, right? It's just personality, I think.
Right, and that's it. Everyone's got their own different risk. Rex?
Yeah. I actually am the opposite of Brandyn to some extent.
Yeah.
And so I believe that there are times in your life to where concentration, it's a good time to take concentrated risks. And I think the younger you are, the more, appropriate that can be, because you have time to recover and you have time to be more diversified. And that's the time to take risks in your life. And so I'm not afraid of having some concentrated positions or buying a home run stock on occasions or things like that. And am I right? Sometimes. Am I wrong? Sometimes, right? So it happens to even out, but I do believe that concentration can create wealth. And I truly believe that. And I think there's times in your life where it's okay to take that concentration risk if you have the internal fortitude to be comfortable with that. And I think that's where you have to do a little bit of soul searching and look inside of, can I really be comfortable if I'm wrong, if this goes to zero, if I lose, if I have to start over? And I think that's where you see a lot of your entrepreneurs, they're very comfortable in that concentration. They're very comfortable starting over and starting over and starting over and then hitting that home run.
Yeah, they almost get better every time. So,
But
sometimes they learn.
You have to recognize you are not increasing your statistical rate of return. You're increasing the probability of swings. You're increasing the probability that you either hit it big or you really lose. You're not increasing the statistical probability that you get a higher rate of return.
Statistically, that is accurate.
Yeah. And everybody likes to believe that they're the one that's not going to fall within the statistics. And I think that's fundamentally myself in most every aspect of life. I don't believe like I just say, all right, here's what happens. I don't believe that I'm going to be necessarily different. And so I play my cards accordingly.
But I think that's capitalism. I think capitalism is taking that risk and believing that you are the 1 in 10 that is going to be different and going to be successful and going to be Jeff Bezos and create an Amazon or a Warren Buffett and have that initially concentrated portfolio and build that into something special. And I think that is capitalism. And I am a full believer in that. And I'm a full believer that I'm willing to take those risks from time to time with my own money. And I think there's stages in life to do that. I think there are stages in life to absolutely not do that. And I think there's certain types of money that you absolutely should not be doing that with. And if you don't have the discretionary assets to do that with, then I don't believe you should be doing that. And so if you're trying to reach a retirement goal and you need all of your assets to maintain that lifestyle, all of your assets to maintain that income stream throughout retirement, then you should not be taking those kinds of risks.
Yeah.
If you have additional discretionary assets above and beyond that, and in addition to that, you have the internal fortitude to handle those swings, and you want to do that and you're predisposed to take those additional capitalistic risks, then I don't have an issue with that.
Yeah, and I agree with that. And I think you're right. I mean, obviously, choosing this career was not exactly a steady government job,
Right.
And I've been very comfortable and super grateful I took those risks. And I've seen clients taking those risks, and I think that's good. But it's also important, just like you said, have that backup plan. If this goes south, I've got something I can fall back on and still be all right financially.
If this goes south. Rex, how would you rank Warren Buffett's risk management?
How would I rank his risk management?
Aggressive, non-aggressive. Yeah, because it feels like Brandon was describing the slow and steady growth, which Buffett's famous for. So where did he take risks, I guess?
So he's absolutely aggressive, right? When you look at where Berkshire Hathaway started and the number of stocks that he had in that for the first 10, 15, 20 years, is a very limited number of stocks. There's a very concentrated portfolio of businesses at that time. And he happened to be phenomenal at finding opportunities in undervalued companies and the internal fortitude to ride through the storms in order to realize those great returns over time. And a lot of people don't have that willingness to do that. When they're down, human nature is to sell when it's down and to buy when it's high. That is human nature.
Or trade your quarterback.
Or trade your winning quarterback, right?
Yeah.
And so he had the ability to do that. Now, that doesn't mean that it's not a risky portfolio. It was absolutely a very risky portfolio. Even today, it's 100% in the stock market. It is more diversified today, although he has a very large concentrated position in that portfolio. And if that happens, that position, that company happens to struggle or falter, then it's still a very risky portfolio.
Interesting.
But it has produced, that risk has been rewarded over time.
Just a quick Google search looks like about 41 to 47 holdings, right? So above that 30 threshold, but still, I mean, by and large, concentrated.
And so while we're talking, maybe Google, what percentage his largest holding is, because I think it's sitting at a large percent on his largest holding. So,
okay, and then we'll get to some more numbers, Brandon, since you're on the computer there.
Top 10 holdings, and again, this is just a quick Google search. Apple, Bank of America, American Express, Coca-Cola, Chevron.
Does it say
how
big
percentages?
Apple is?
It doesn't say how big. Not this.
Yeah, so I'm. Last time I had read his prospectus and his annual report, it was a strong double-digit percentage inside of there.
20 or 50?
I think it was north of 20.
Wow.
If I remember correctly. That was in there.
Top 5. You might have to edit some of this time out.
Yeah, you might have to edit some of these breaks
Apple. Out. So Apple, largest stock holding by far, 905.6 million shares worth $174.3 billion, accounting for about 50% of its stock portfolio.
Yeah, that sounds about right.
Holy cow. Okay.
That's a bet
right now.
Huh.
Yeah.
That's a bet.
So he's not afraid of concentration, right? And he's not afraid of taking those risks over time. And he's done that with different companies throughout history, whether it was American Express for a while or Geico for a long period of time. There's different companies throughout Warren's history to where he's had concentrated positions in the portfolio. And he, again, that's why he's dubbed, the Oracle of Omaha and the greatest investor of all time, is because he does have a combination of a strong understanding of great science, of understanding the math of the businesses, and great art, which is the intuition of the businesses, because it's, the market is inefficient. And so he does a great job of marrying the two. Doesn't mean he's always right. He's not always right. And on occasions he's wrong. And when he's wrong, he can be wrong in a big way during different periods of time. Matter of fact, there's articles in Newsweek about, the death of Berkshire Hathaway and the Oracle falters. And there's all these headlines that you can go back in history and see during periods when he has struggled during different times and his strategy has been underperforming. But he's patient enough, because most things go in cycles, for that to recoup and come in very, very long. But those are risks that as you go into the market, if you're going to have a more concentrated portfolio, you need to be patient. You need to be able to ride through some of those cycles and have other assets that you can pull from if you need to pull from during those times, to where you're doing the opposite of what human nature tells you to do, to where we can sell high and buy low, or sell steady if it's a steady asset like CDs or bonds or things like that, as opposed to having to sell low.
Yeah. I think that's a great point too, though, of risk. There's so many different levels of risk. Putting 50% of your stock into, or of your portfolio into one stock, I think both of us would kind of like hesitate on. Obviously, I wouldn't recommend that to a client, right?
Right.
That would make me personally incredibly nervous. I know you accept risk a lot more than I do, but then even then I look at my personal financial plan, and I mean, when we sold our first house and bought our second, we took a huge amount out of the equity of that house, accepted a higher, a mortgage payment, and then put it all in actually an incredibly aggressive stock portfolio.
We're not recommending this either.
We're not right.
But you're giving an example of what
but that's higher risk, right?
Yeah.
And
it absolutely is
and
more risk.
And you know what? I put it in, and immediately that was the peak of, or the first part of 2022, and it fell. Right, that full year, I just watched all of the money I put in just kind of fall down, and since then it's recovered, right? And it actually, I was surprised how little sleep I lost. In fact, I didn't lose any sleep because it was well diversified. I knew it would come back. I knew, historical norms. But it's interesting. I guess the reason I bring that up is I think risk is so relative, right? And here I am. I consider myself a fairly conservative guy. But if I can take a risk that I think is I can look at it statistically that it has a very, very high probability of playing out well, I don't worry about it. And I think that can be applied to a lot of people's financial plans. Not necessarily taking equity out of your house, right? But that is assuming you understand the risk. There's a lot of opportunity there.
Yeah, I think you didn't lose sleep because you have a teammate that you work so hard for. That's so tired that you're just exhausted and didn't have time to stress about it. So.
Jeez. Yeah. All right, Brandon, let's do some more numbers.
All right. I've got a 7 out of 10.
A doozy? Is it a doozy?
Yeah.
Oh, 7 out of 10.
7 out of 10. It's maybe 7.5.
Okay.
So 2/3, and this comes from Yahoo Finance, TIAA Institute put this together. 2/3 of Americans say they're saving for retirement. So I thought that was interesting. While
so the other third is doing what exactly?
Maybe they're in retirement. Maybe.
Yeah, maybe.
It's maybe hard to say.
Maybe they're under 18.
It wouldn't surprise me at all if that was working age though, and that are just not right, and saying, hey, things are tight, we're going to get to it. 2/3, honestly, I thought was a high number, right? Based on 401k enrollment. So often people are like, hey, it's a tight year next year. And then that next year never comes. So I always start saving. However, did you have something?
I was just going to say, I was meeting with a young man, 29 years old, the other day. And he was debating on, should I continue with my 401k or should I be saving for a house? And his solution was, they were exclusive of each other. Yeah. And it shouldn't be exclusive. You should be doing both. Is the answer that I would give. But it doesn't surprise me. I think as people are going from 20 to 30 and even 30 as they're raising kids, things like that they put a higher priority on immediate needs and immediate life as opposed to long-term goals. Yeah. And so I'm not sure 2/3. That may even surprise me to the high side.
Yeah. Follow up on that is that nearly 1 in 4 Americans have no clue where their retirement balance stands. And I think my comment to that is that whether you're in that 2/3 that's actively saving and actively engaged and you know where your positions are and what funds you hold and all that, or you're that 1 in 4 that has no clue, hopefully you're still saving, but you're just like, I don't know, that's not for, we can help both. Right. And we have clients that are in both camps that are actively engaged. They want to know every number of every cash flow from here to age 100. And we've got other clients that are like, hey, you know what? This isn't my cup of tea. Right. This isn't what I do. I trust you guys. And we can help both. Right. By setting up, making it automatic, setting things up and just getting it going. And I enjoy when clients are really curious about it and I can dig into the numbers with them. But I also enjoy, working with clients that are like, hey, I trust you. I just need this to happen. And we just make that happen for them.
Interesting. Well, we did touch on this definition of a word here, but didn't kind of use the word. So, Rex, do you want to talk about loss aversion?
Some words I don't use.
I know. Well, yeah, especially on this podcast. But yeah, loss aversion. So the psychology of that and what that means.
So loss aversion, essentially being afraid of loss, right? Is that the way I like to describe that is the pain of loss is greater than the joy of gain. So let me say that one more time. The pain of loss is more than the joy of gain, meaning that they cannot, when a portfolio goes down 10% and so 100,000 goes down to 90, that's much, much more painful to this type of an individual as opposed to 100,000 going to 110. They don't get very much joy out of that. And I think that is absolutely one type of risk that we face a lot is people, especially in down markets. I think this identifies this type of personality. So if you're listening and you have a couple of these traits, you might find yourself in this loss aversion conundrum, if you will. And so, but essentially the way it is when the market is down. So, here we are in the middle of April of 2024, and the market has dropped about 5% or so in the last 2 or 3 weeks. And that's been very stressful to people. And so we're getting, we're not getting calls yet, but I would anticipate if the market continues to drop, we'll start to get calls of, should we be taking less risk? Should we be selling? And that comes back to human nature of selling low while the market is down, as opposed to the opposite of buying while the market's down. This same type of individual, a month ago when the market was up 8% in 3 months, was calling and saying, oh my gosh, should we be taking more risk? Should we be having more in the market and making more money? And so they want to buy at the high and sell at the low. And this is just a textbook definition of loss aversion of that type of personality traits in my mind.
Brandon, you want to expand at all on that?
No,
Okay.
that was
good.
Perfect.
Good job, Rex. So that kind of falls into the last topic here before we got to run, and that is the cost of risk. And so, again, we danced around this answer too, but not taking any risk. What does that cost you, Brandon?
A lot. It can cost everything, right? And so I think it comes back, wrapping right back to where we started, understanding risk. Risk is not, it's not... You need to understand it, and you need to be able to apply that in your plan to be able to get more out of the opportunity, right? We can always throw money in the bank and CDs, but when you start to put a plan together and you compare the difference of lives, right? Whether that be inheritance given to kids, whether that's vacations and life lived now, you can do a lot more if you can accept an appropriate amount of risk. And so usually I've found the more people understand what risk is and our backup plan for when things don't go as planned, the more you can understand that, the more you sleep at night, and the more you can get out of your financial life.
Excellent. Rex, final word on cost of risk and risk management?
I think a great example of opportunity cost and cost of risk is real estate. And so I'm not recommending this, but this is just to prove a point, and it's a great example. But when somebody buys a house, let's say you buy a $500,000 house, and you choose to put down 20% or 30%, let's say 30%. So you're putting down $150,000 onto this house as a down payment. That's something that you're choosing to do. Now, the opportunity cost of that is you could have, if it was a primary mortgage, first-time home purchase, maybe you could have put down $20,000 instead of $150,000. And so that $130,000 could have been redeployed into an investment portfolio or something like that, and grown at some average rate of return. Let's call it 6 or 7%. The house is going to appreciate the same whether I put $150,000 down on that house or I put $15,000 down on that house. That house appreciates identically.
Yeah, the house doesn't care.
Now you have to weigh out the cost of the mortgage and the interest expense versus the growth on the other side. So you have to do the math in there to see what that opportunity cost truly is. But the opportunity cost of how else could those dollars have been utilized as opposed to sitting in a bank account, as opposed to sitting in a money market or a CD or in an investment portfolio versus paying down debt that's at 20% on a credit card, right? Because that's the flip side of that opportunity cost is you had a 20% guaranteed rate of return essentially by paying down that credit card versus a risky rate of return of some rate, 7 to 10%, whatever the rate is in the market. And so both sides of that opportunity cost needs to be weighed. And you know what? We're pretty good at that.
Yeah. Yeah. So if you do have questions on risk management or just want to feel comfortable with your money, have some investments that you want to chat about, visit planwithbaxter.com. I want to say thanks so much to Rex and Brandon for being on this episode of Through the Pines. This has been Through the Pines, reminding you to use yesterday's dollars to finance tomorrow's dreams.